Hey, what is going on, everyone? Welcome back to the channel all about real estate. My name is Lewis, and we are going to jump right into it today. We are going to be discussing mortgage rates, where they currently are. We're going to give you an update on where we think they're headed, and we'll jump right into it. If you are new to this channel, we talk about all things finance, real estate, and investing. So if you want to learn how to buy, sell, or invest in real estate, this is a great place to learn. Make sure to tap that subscribe button and that like button below. Let's go. Okay, so up on the screen, I have the CNBC homepage. Reason we're going to check this out is because I want to show you the 10-year Treasury yield. Reason why is because the mortgage rates tend to track the 10-year Treasury yield in almost lockstep fashion, meaning if the yield goes up, rates tend to increase. If the yield goes down, rates tend to go down. So let's go ahead and click on the 10-year Treasury yield and see where we're at today. We're obviously up a little bit today, which means that mortgage rates have increased slightly, or at minimum, the margin has increased where it is slightly more expensive to secure a mortgage loan today, like a 30-year fix as an example. So if we're looking here over just the last, let's say, couple months time frame, like November, October, we actually have seen the 10-year Treasury yield rise slightly, hitting highs at around 1.66, pretty close to 1.7. As of late, the 10-year Treasury yield has came down. So now if we're looking at a long-term, more of a 5-year view, you can see that the 10-year Treasury yield is still relatively low. Sure, it's not as low as it was a year or a year and a half ago, but in the grand scheme of things, you know, if you go back 4 or 5 years, we were sitting at about 3.2%, and now that is basically cut in half or a little bit less than half. So mortgage rates are still really, really low right now. All right, so now let's go ahead and take a look at where mortgage rates actually are. I have the Freddie Mac website up here, and it's giving us the United States weekly average for the week of December 2nd, 2021. And it has this really cool little chart here, as well as kind of outlining where the rates are today. So the first thing I want to point your attention to is the 30-year fixed. That is sitting at 3.11% as an average, with approximately 0.6% in points. If you're not familiar with points that is a percentage point of the actual loan amount itself. So as an example, if you have a $300,000 loan, you would multiply that by 0.006, and it would give you about $1,800 in cost. That is the point structure that is associated with securing that rate of 3.11%. Now that, of course, is an average. There are lenders that are going to be less expensive. There are lenders that are going to be more expensive, but at least it gives us a ballpark of kind of where we are today with the 30-year fixed mortgage. Now for the 15-year fixed, we're currently sitting at about 2.39%, and that's at 0.6 in fees and points as well. Now, if you're looking at this chart, what's interesting here is that, as I mentioned in the 10-year Treasury yield, we have seen a spike. So you see how the rates have trended down consistently into basically the end of 2020, and then into 2021 we've started to see an uptick. They've been sort of consolidating sideways, but it looks like the overall trend is starting to head up. Now, with that said, if we zoom out to a larger chart, let's say a 10-year chart, you can still see that the interest rates are hovering at all-time record lows, even if you go all the way back 10 years. Okay, so now that we know that the 30-year fixed interest rate is hovering in the low 3% range, depending on how you structure the fees, there's a couple points that I would like to further discuss. Number one is that the Mortgage Banker Association is estimating that interest rates are going to increase into 2022. They are estimating that by the end of the year, we're going to be in the upper 3% range, somewhere close to about 3.7%. What does that mean for you as a potential home buyer or somebody who is considering a refinance? As a home buyer, it means that your purchasing power is going to be decreasing. So if home prices stay relatively flat or they actually increase a little bit, that means your payment with a higher interest rate will increase. Now, if you are a borrower that is considering a refinance, whether you are looking to lower your rate and lower your payment, or if you want to take out some cash and do some debt consolidation or something like that, basically the same thing applies. We are currently sitting still at historic record low interest rates, and as we increase, the savings or the benefit gets compressed. Anyway, my point being is that if you are on the fence and you are considering a refinance or you're considering a purchase, now may be a great time to lock in that 30-year fixed rate debt, because we do see higher rates on the horizon. It's not a guarantee. It's just simply a forecast based on the economic climate that we are currently in. That is going to wrap it up for today's video. I would love to hear from you. Where do you think mortgage rates are headed? Where do you think the home prices are headed? Do you think we're going to see increased appreciation or increased home prices going into 2022? Do you think rates will go up? Do you think they'll go down? Please leave a comment below. And if you haven't done so already, please consider hitting that like button and that subscribe button to see more weekly videos on finance, real estate, and investing. My name is Lewis. Have a great day.